Hi there, welcome to Business Day on BNN and Sirius XM 167. I'm Andrew Bell, sitting in today for Francis Horodelsky. We're just getting into earnings season now. The excitement is building. For a preview of today's trading, we are joined by David Burrows, President and Chief Investment Strategist with Barometer Capital Management. David, hi there.
How are you, Andrew?
Good. Thanks for joining us. Earnings season, are you looking for a blowout? Are you looking for decent earnings?
I think, Andrew, the evidence is that probably earnings come in ahead of expectations. If you look at the pre-announcements this quarter, they were way down over recent quarters. And earnings revisions from analysts came in quite strong over the course of the quarter. So against a backdrop of the last few quarters, I think this is going to be a very good quarter.
So you're confident that stocks can go higher here? You don't think there's a bubble feeling in the market?
I think that the hardest part for investors is that we have left an environment that we were in between 2000 and 2012, which ultimately was a secular bear market, one where the markets worked their way sideways for 12 years. And through that period, the earnings multiple that investors were willing to pay contracted as they generally lost confidence. In the last 18 months, for the first time since 2000, not only have we been seeing earnings rise, which has been going on, but we've seen multiples start to expand. And that's a difficult time for investors because they can't point to earnings growth as being the full support for why share prices are rising. So basically, equities are being revalued versus other asset classes, and in a rising multiple market, which can go on for years, it's sometimes hard for investors just to stay with the market as long as it's working.
Why is that? Just people have got into that old mindset?
Well, they say, well, the market's near highs, it's trading at a higher multiple than it was last year, so it must be expensive. And over the last 12 years, we've had several sort of short-term rallies and difficult declines that have caused people to feel that they really have to jump in and jump out. And I think that we really have exited that world and we are in a new secular bull market. So we do have good earnings growth. But when you look at relative valuations and where investors can put their money, interest rates do look as though they are likely to stay lower way longer than people expect. And for those people who need to find some source of income, the return that they can get through dividends, and especially dividend growth, makes equities look very attractive because corporations have very strong balance sheets and are very willing to return capital to shareholders. And I think that given the demographics, this revaluation of equities could go on for years.
Now, obviously, a great trade over the past few years has been those big dividend-paying stocks, the REITs, the income pigs. You think there is a shift going on, even though there's no prospect of interest rates rising abruptly anytime soon? You think there's a shift to more growth-oriented areas?
Yeah, I think because we are in a better economic environment, you are seeing money slowly move toward more economically sensitive companies. And specifically, if you look at what's really working, it's companies that have a great record, not just of paying a dividend, but very strong dividend growth and something in their business model that allows for that. So if you can get a 3 or a 3.5% yield that could grow at 10 to 15% a year for the next 3 to 5 years, that starts to look very attractive relative to a 2.5% 10-year Treasury bond.
So, well, let's get into some names. Alta Gas, now they're obviously in the very lucrative business of processing other people's gas. They're a huge player in pipelines, or a growing player, energy generation. And they're also pushing forward with an LNG plant, or plans for an LNG plant in British Columbia. Capital intensive business, there's obviously risk, but you like this name.
Well, so we have been big believers for the last few years in energy infrastructure. We're going through this boom in oil and gas production in North America. And of course, all of that stuff has to move from the ground to the market. And the pinch point up to this point has been the ability to transport and process it and get it there. And so those that have that infrastructure are making very good economic returns and have been able to build great new assets that will provide them income and cash flow going forward. Alta Gas has some great regulated assets. They also have very good pipeline assets, but they are prime set up to benefit from the next move, which will be infrastructure for liquefied natural gas. They have really the only pipeline system across BC to Prince Rupert, and gives them opportunity. Now, they are bidding on assets currently that would give them another leg up for LNG, and we think that they could have 10 to 15% dividend growth for the next 3 to 5 years.
CIX. Now, it's obviously a mutual fund company, very successful at attracting, retaining assets. In a way, this is a bet on the stock market on steroids, isn't it? When the stock market goes up, the mutual fund dealers tend to, or managers tend to do well.
Sure. So if you believe we are in an up cycle, you want to move more toward things that will benefit from that cycle. CI was able to grow their assets in a very difficult environment. In a better environment with good performance records, they get new inflows of capital coming in. They also get the fee revenue on existing assets. And so not only can they continue to pay what they've been paying, but they grow their dividend as well. This company has grown its dividend over 10% a year for the last 3 years. Bank of Nova Scotia has sold their shares, or the large part of their shares. That overhang is gone. They've announced a 10% share buyback, over the next year. We think that ultimately this stuff is very, very good. And if you believe this market, with of course setbacks along the way, is likely to work higher over the next 3 to 4 years, then ultimately you would expect to get a pretty strong return both from on the share price and on the dividend stream.
And finally, you're going to talk about a good old industrial stock, feeds into your thesis that growth areas look promising. LYB, they're in plastics. Why do you like this name?
Right. So if you believe that we are in a bull market in oil and gas production in the U.S. that could really change the dynamics for industrials, you want to see who benefits from that. If you think the economy is getting a little bit better on the demand side, again, who benefits from that? So Lyondell produces chemicals that are used in production of plastics, packaging, auto parts, and so on. Their biggest feedstock cost is natural gas, which we know is very, very low priced in North America compared to the rest of the world. So Lyondell's taking very low feedstock costs, producing products that they're seeing increasing demand for, and making a very good margin along the way. So this is a little bit more cyclical, a little over a 3.6% dividend yield. Again, has grown its dividend over, well, it was 40 cents a share in 2011. The dividend is $2.40 today. They just raised their dividend by 16% in April. Again, strength in the economy helps them. Low gas prices help them. Stronger demand helps them. This is a play on a better economy.
David, we'll have to leave it there. Thank you so much for joining us.
Andrew, thanks for having me.
David Burrows of Barometer Capital Management.